This week on Market Boys, oil prices are falling due to the U.S. and Iran peace deal. The Feds are watching, and the market is reaching new heights. What's coming next?
Welcome to Market Boys, where we break down the markets, the economy, and retirement planning in a way that actually matters to your life. I am Andres Sanchez.
And I'm Xzabko Scott.
And today, we're talking two stories that could shape the second half of 2026, Xzabko, right?
Yes.
So, a major breakthrough between the United States and Iran that's sending oil prices lower. Why Federal Reserves might be closer to changing his tone on interest rates. That's a big one, right, Xzabko?
Huge. And we're looking forward to it. Let's drop it instead of rising, right?
Correct. And if you retire or approaching retirement, maybe you manage your portfolio, these stories could have a direct impact on your finances. So let's dive in, right? A lot of stuff happening this week as well, Xzabko.
Oh.
So we have an IPO that was started on Friday. It was a long wait.
Indeed.
For SpaceX.
Indeed.
Correct. So people are buying the hype.
Exciting.
Correct.
Exciting. There's so much to it too that SpaceX has to offer that, you know, if you get a hold of it, you jump on the train early, you may be surprised by what they have in store for us in interstellar or planetary travel, if you will.
Correct. So let's go to the moon or Mars, right? At this point. So let's start with a question, right, for the public, because obviously we have the peace deal, right? That pretty much looks like it's done. Let's see
Maybe.
what happens, right? But the markets took it very positively. They were very positive about it. They reacted really quick, right? The price of oil dropped, right? We were like seeing oil prices on the hundreds, right?
Mm-hmm.
And
That's right.
yesterday closed around in the low 80s.
Not bad.
Which is really good, and
Not
how
bad.
that impacts, right? Everything else. So let's focus a little bit on that. So what is the biggest inflation threat in the past 2 years, right? Suddenly became an economic tailwind.
Right.
So for months, investors fear higher oil prices. Today, we're discussing what happens if oil starts moving lower instead.
Well, that's going to make a lot of people happy, and production is just going to push forward, right? So everyday living that involves oil will ramp up a little bit more intensely, if you will. Right, less stress. And here's another one. If inflation falls because energy prices drop, could the Feds finally get what it's been waiting for?
That's a good question.
Interesting stuff. Let's dive in.
So the old story nobody saw coming, right? Let's start with that. The biggest market story this week wasn't technology. It wasn't earnings. It wasn't AI. It was oil.
Oil.
All right. After months of geopolitical uncertainty, the announcement of a potential peace agreement between the United States and Iran sent crude oil sharply lower,
Right.
like drastically lower. So the markets reacted immediately, right? Investors started pricing in the possibility of increasing oil supply entering into the global markets, which helps everyone, right? So also the Hansen and the Nikkei closed higher yesterday as well. The Hansen, yes, in Hong Kong did pretty good. The market in India as well took it positively. Interesting in China, react a little bit not too well. Wonder why.
Right.
But we can dive into that a little bit.
Indeed. Now, let's explain why this matters. Many people think oil only impacts gasoline. That's a mistake. Oil influences transportation, manufacturing, food distribution, air travel, shipping, plastics, and consumer goods. In other words, oil is embedded in almost every product Americans buy.
That's right. So it affects everything.
Everything. And unfortunately, we don't have a material or a substance such as oil that can replace all of those versatilities.
Yeah, I mean, it's energy just runs everything, even what you eat.
And they put oil in that too.
Sometimes they can, right? But that's important because you say you cannot choose not to eat.
Right.
At some point you have to eat, right? So when oil affects pretty much everything, right, and impacts the consumption or your life, now comes something very interesting to think about, right? Inflation often arrives in a truck, right? Think about that. Inflation often arrives in a truck. If transportation costs falls, the ripple effect can be enormous for everybody, right? Because think about it as more like a tax cut these days, right?
Right. Exactly.
You're gonna have some excess of premium or money on your pocket. So if you're able to spend less in gas, if you're able to spend less in travel, and if you're able to spend less on food, because now the cost of transportation lowers. So what do you would do with that excess of money?
Well, you're going to save it, or you invest it, you
choices.
buy more things.
Choices.
And this is kind of the idea, of when this happens, right? Okay, we lower the interest rate, we lower prices, right? People are going to spend more on other things, right? This is what ultimately the economy needs.
Yeah. So if gasoline dropped by $1 per gallon and it stayed there for a year, will you spend more? Will you save more? Will you invest more? Take a moment and think about how that affect your household budget.
Significantly.
For some people will, right?
That's right. Many investors underestimate how much money they spend on energy indirectly. Lower energy costs can improve corporate profits, consumer spending, business confidence, and that's one reason stocks responded positively.
So historically, periods of falling oil prices have often helped economic growth, right? But not always, but many times. That's something to keep in mind. Lower fuel costs act like a tax cut for consumers. More disposable income means more spending. More spending means a stronger economic activity, right?
Indeed. But let's ask the hard question. Who loses when oil falls? Energy companies? Oil producers? Certain regions heavily dependent on energy production. Every market moves create winners and losers.
That's right. And here's something worth write it down for you guys. Every economic challenge creates an investment opportunity somewhere else. When one sector struggles, another often benefits. And that's the market of opportunity, right?
Right.
And when we get to see so much shifting between markets, I know everyone is on the hype of AI, energy. Obviously, SpaceX. We talk a little bit about that. But what are the valuations?
Indeed.
Correct.
Indeed.
When you look at earnings, they're on the peaks, on the high peaks of all time. So much valuation. I mean, can it go higher? Probably.
Oh,
but
yeah.
How much? So it's like, do you rather take the risk to gain a 10% more, or keep it safe and earn, 6% on the safe side? How much that 4% spread is worth? Willing to take 10% more, risking 20% to 30% of your portfolio, or taking 6% of the earnings, 6% guarantee per se, right? On the safe side, but providing risk on your providing less risk on the portfolio.
On portfolio, oof. That's tricky because we all know business models, right? When investors look at it, you want to get in fast and get out fast, right?
Those are the ones who lose.
Well, if you
they get burned pretty fast.
If you can double, triple your money,
yeah, it's like the casino. Right? You roll it out, you can triple your money, but the casino they win.
Right. Because don't let me get into the casino concept.
Right,
we're in Vegas.
There you
we
go.
know
Exactly. So, like when you're playing blackjack, right? I mean, the odds on the house is always 52% they're going to win, and 48% that you might win. So, yeah, that's gambling, right? So when you are putting a time horizon and you're looking at an investment, 5-10 years, right?
Right.
How does it look like? How does that valuation looks like? How strong is the market, the opportunity, of course. Like what's happening for SpaceX is like there is no data.
Indeed.
You know? And what we've seen in the last year and a half with artificial intelligence is that there is also no data, right? Mm-hmm. We are going into new frontiers per se.
Pioneers.
So yeah, I mean,
exactly.
The universe is the limit.
So you have to.
There is a price to pay for that.
Indeed, and fortunately, we know Elon Musk's history, right? So we can kind of make a decision based on his own credibility with building solid companies, right? So we can put our faith that we know that he is going to hire the best staff, intelligent people. Him himself is going to be 100% involved. So we know it's going to go in a positive, in an upward trajectory. Now, how much do we invest? That's the tricky part, right? Because we know it is a baby as far as a company, right? And where they're trying to go. Now, he said that he gave it, in his conference, he gave SpaceX less than 10% success rate. Less than 10%. And now here it is. It's the number one IPO, right?
Yeah, amazing, a trillionaire right now. Correct.
Incredible.
Yeah.
Him himself gave it less than 10%.
Mm-hmm. So, yeah, I mean, there's a lot of hype on it. There is many different ways to participate in that, not concentrate so much risk directly.
Right.
Or exposing your portfolio directly in it. I like to give 6 months normally when I see these IPOs.
Not bad.
Because they run up and then they just have the little correction when valuation comes in, when, things like common sense.
Well, that's the lockup period too, isn't it? So that's a lockup period, right? So then the investors, even though they have some special stipulation for certain investors too, 6 months, people are going to be able to start selling shares of SpaceX. So that's a good time to really, narrow down. Okay, who's going to hold? Who's selling? Right?
Yeah. I mean, think about this. Like, Elon Musk controls the company. He's the
40%.
majority holder.
He's holding 40% right now.
I don't know. I thought that he was 51.
No, he's 40%. So I would imagine when that time comes, when that lockup period expires, right, and investors are able to sell now, some are going to cash out, and I have no doubt in my mind Elon Musk is going to buy. I would.
I don't know.
That's I'm not different. Elon Musk.
Correct.
Now let's connect the dots. Because lower oil prices lead directly into our second story, inflation. And inflation leads directly to the Federal Reserve.
The Federal Reserve. That's the next move, right? For over 2 years, the market has focused on one thing, interest rates. Every investor wants to know, what is the Fed going to do next?
What are they going? No. What are they going to do next? Remember, the Fed has one major inflation target, approximately 2%.
Yeah.
When inflation is high, rates stay high. When inflation cools, the Fed gains flexibility. They buy.
So right now they're like against the wall. I mean, they're looking wisely, right? And we also have to take in consideration that we have a new chairman too.
Indeed.
So a lot of moving parts.
Lots of moving parts. It's an exciting time.
Yeah, maybe, right? And that's why lower oil prices matter right now, because energy is a major inflation component. If oil continues falling, inflation pressures eases, right? And that doesn't guarantee a rate cuts per se, but it gives policymakers more room.
Right. Absolutely.
Now, here's a question for all of you guys. Would you rather have a 10% stock market return with high inflation, or a 6 or 5% return with inflation under control? Think about it. What will you do? Because real returns matter more than headline returns.
That's right. So safe to sorry, of course, right?
Yeah.
That's one of the biggest mistakes investors make. They focus on returns. They ignore purchasing power. And the portfolio growing 8% while inflation runs at 6% isn't nearly as impressive as it sounds. But
yeah,
it is
it's
safe.
safety, right? Now, write this down, guys. Your real return is what matters, not your reported return. Why retirees should pay attention to this, especially if you're about to retire or you're retiring right now, you need to pay attention to this part.
This becomes especially important for retirees. Retirees faces three risks: market risk, inflation risk, and longevity risk. Most people focus on only one.
Exactly.
Why is that?
Because most people, the market has an adrenaline. And when you don't see it with an economic perspective, right? With discipline, with entry and exit points, with perseverance, pretty much it's like going to the casino.
That's right.
And that's why it's so emotional.
Right. They're treated like a casino.
Correct.
Instead of an investment and or business. They're way too emotionally involved.
Exactly. So that's very common, right? So they don't take in consideration, like, for example, you were talking about longevity risk. I mean, people don't see themselves when they're retiring, okay, what happens when I'm going to be 90? They don't want to think about that stuff.
Right.
Right? But it's a risk associated with it. They just think about the market risk. Right?
Right.
Well, they don't think about the inflation risk.
Right.
They think about the market risk.
Well, the market risks and inflation risks are intertwining, right? So we have to think about both.
So think about all those people that have some pension accounts that they were giving them 3 or 4%, right? And they have it for 10 years since 2015. And then inflation hit. Now, today, they were locked on those returns where they were not able to even keep up with inflation.
Right.
And you're in a fixed income.
Ouch.
It's brutal.
Very brutal. Now, when I think about longevity risk, when you mentioned 90, wow, if I'm 90, I just picture myself, and I have really good genes, but I picture myself not moving fast.
Yeah.
And needing some help, possibly a skilled nurse to come out and help me with daily activities, right?
Correct.
Now, I cannot imagine being in a financial strain at that point. Like, what do you do, right? That's tough.
Yeah. It's funny you say that, because I right now have one of my clients is in a rehab facility, and we were looking and considering, okay, wow, he's going to need more care, and eventually the insurance is going to say no more, right?
Right.
And it's around $365 a day.
Wow.
So 20 days, right, is another $7,200.
That's right.
So for somebody who's on
Fixed income.
fixed income, right,
That's a nightmare.
And now you have to see, okay, quality of life or staying alive.
Right.
So very, very difficult when you don't plan properly, right? When you don't do the things correctly. So taking in consideration again, longevity risk, inflation risk, and obviously market risk, because the market's always going to be there. So let's discuss something that usually helps in this type of moments, right? And is the fixed income opportunities. Okay, many retirees spend years earning almost nothing in CDs and bonds. Today, the environment is very different. Higher rates have created opportunities, correct? Because now while money is expensive, right? High quality bonds, fixed annuities, MYGAs, right? Buffer accounts and income focused portfolios, they're a good strategy. Because let's say, if you are able to lock, I don't know, let's say 7% or 6%, right, for the next 5 years.
Consistent. So your money will double. Well, it'll double in 7. So the next 5 years, you'd be close to doubling it, right? Not bad.
And we know that the Federal Reserve has a target to bring it down inflation to 2%, right?
Right.
That give you, let's say, if you're able to lock 6% rate, you locking in a 4% spread earning.
Not bad. Not bad. Compared to 2, being that it's at 4.
Yeah. So good opportunity. Now we can see on corporate debt also there is high returns, right? I mean, look at people getting, easy they can get between 8 to 12%, right? On income.
Indeed.
On that. So
Indeed.
it's a lot of opportunity out there on the fixed income arena. That it looks very attractive.
Right. Well, and they're competing, right? The insurance company are competing for your business too, so they offer bonuses.
Correct. On top of that, you have some insurance companies that they provide some lucrative numbers because again, money is expensive right now.
Absolutely. Right.
So income-focused portfolio, guys, again, is a good opportunity for those portfolios that maybe 5-6 years ago they struggle to provide decent income. Today, that's not the story. So,
right,
great opportunity to hedge.
And here's the key: you don't need to predict every market move. You need a strategy that can survive multiple outcomes. That's the name of the game. Right, you got to diversify, if you will.
Correct. That's for sure. If the market fell 15% tomorrow, right, will your retirement plan change, stay the same? What will happen? Or will your retirement plan stay intact? There is a big difference.
That makes sense. Retirement success isn't determined by market prediction. It's determined by preparation. Are you ready? Or do you have to get ready?
Correct. And that preparation requires discipline, right? We're talking about that roller coaster that comes in when, people see their account go down and they just can't take it. Right? It's emotional. It's on paper. But so is the earnings. They're like, oh, I make so much money. Well, you really didn't take out your earnings. You didn't earn anything.
Right.
Right? So it's having that discipline and have a plan and a system and follow it to the T.
To the T.
Without emotions.
Indeed. Just focus.
Right.
Focus. I keep thinking of Kevin O'Leary when it comes down to this, right? Have you seen it when he talked about signal and noise?
No.
So he talks about how he worked with Steve Jobs, and Steve Jobs have a ratio of like 80-20 when it comes down to signal and noise, and it boils down to 3 different things per day that you do, no matter what, and that's the 80% that you focus on throughout the day, right? That leads you to your success in the future. Now the 20% is the noise, right? So this could be your friends, your family, right? Internet, scrolling online, things, emails, who knows, right? So that's all like noise because it's not productive to your cause, right, of success in business, if you will, right?
Create distraction.
Oh yeah. So he says that Elon Musk has a 90-10 ratio, right? Of signal and noise. Like he almost feels like he's at 100%. He's a machine.
He's intense, yeah. He's wired different.
Indeed.
That's
and
true.
So it's inspiring when you think of it that way, right? Because it's the law of three, if you will, and the 80-20. Now there's a specific name for that. I can't remember what it was for the 80-20 rule. But anyway, the 80-20 rule. Signal versus noise.
Interesting. It's to know that. Now, the goal of retirement planning isn't maximizing return. It's maximizing your confidence, so you can have also peace of mind, and then you can rely on something for the future, because the future is unknown.
Right.
We don't know if we're going to be healthy, we're not going to be sick, we're not going to die, or we're going to live longer. We do not know. So how the young self, right, prepare and pay itself for the future me.
Right. Agreed. And again, you have to be mindful, right?
Right.
You have to be focused. You have to think about these things daily, and stick with it.
And with so many changes rapidly right now, what I've seen in this year, right? What investors should be watching now? Okay, so what should investors be looking at during the next several weeks? And there are three things. Number one, oil prices. You got to keep looking at them, right?
That's right.
Do they continue to move lower, or does geopolitical risk reappear again? Right? Because right now, the war is on La La Land because of the World Cup.
Yeah.
So a lot of people are distracted.
Now we're talking. Everybody trying to get their hand back in the cookie jar, right? So
per se, right?
So prices could fluctuate just from that.
Yeah, correct. Yeah, I mean it could be. I don't know, but I seen the stadiums. I mean, all the tickets are like 1,000 to 10,000, and
that.
they're all at capacity, max capacity.
Front row seats at 10,000.
Like record assistance on all these stadiums.
Insane.
It's insane, right?
Insane.
So it's a lot of money flowing in, a lot of cash going in, a lot of excitement. Obviously, it's this time of the year when kind of like the world pauses because everybody's paying attention to only one thing.
Right. And
sports.
They're not realizing that there's a lot of people out there that have money, that are well off, right?
Yeah.
It's a lot of people out there. And like you said, the stadiums are packed, even though these prices are outrageous.
Correct.
It almost makes you feel like if you're not in a position of financial freedom.
I'm thinking about this. It's like not counting lodging, right? The travel expenses, food.
Right.
It's quite an expense. I mean, I know some people in emerging countries. I mean, some people mortgage their homes.
Oh yeah, yeah.
This is how important it is. This is how important it is for them, right? It's
oh my God,
it's
that's
big.
insane.
It's a big thing.
Wow.
Right?
So they will mortgage their home instead of investing it in other things. They will go to
it's a game.
Wow, that's impressive.
That's the most important thing.
I will mortgage my home and put everything. Well, not everything.
Yeah,
I'll put
think about it. It's a way of living, right? It's a passion.
Yeah.
Right.
Yeah.
So some countries have this passion that others don't, per se. They live the sport in a different way.
Right.
Correct. So some people they save for 4 years just for this time.
Yeah.
So it's interesting.
But you just saved me from my strategies here.
There we go.
I don't want to reveal my strategies from. No, I was kidding.
Yeah. So we talk about oil. That's number one, right? Number two is inflation reports. Watch the CPI and the PPI.